Hi, I'm Steve Van Metre. Welcome to your weekly economic update, where we take about 30 minutes every Friday to try to make sense of the economy and markets that just don't make a whole lot of sense. In fact, I just got a call from one of my clients that I was turned on the radio and they said the economy was best ever. Right. Yeah. Okay. Not even close, but that's what you get during these times. People will come out and they'll tell you buy stocks because they're high. You know, I've never made money buying high, never once. And if you buy anything low enough, it will eventually go up in value. I mean, there's very, very few things that you can buy low and go to zero. But there's lots of things you can buy low. When times change, people will want to buy. Now, I've got to get the disclosure out of the way because we've got a few things to cover. The content of this video is provided as educational information only. Is not intended to provide investment or other advice. This trail is not to be construed as recommendation or solicitation by selling security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre. All personal capacity opinions expressed in the video that everyone do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. All right, with that out of the way, today's topic is stocks or bonds. Someone's got to be right. And I've gone back and looked at the chart. We have never seen, unless I've just not gone back far enough, as big of a divergence between stock prices and U.S. Treasury yields as we have right now. What that means is one's going to be right, because based on our monetary system, if stocks are going, well, one of these days I will, no, there we go. That doesn't seem right. But anyways, when stocks go up, Treasury yields should go up. What does that mean? So when stock prices rise, it means liquidity conditions are easier, financial conditions are easy. Also should imply that money is moving around like crazy. Well, if money is moving around and money is being dumped into the system, what has to rise to absorb it? Interest rates, they have to go up. That's how our monetary system works. That's why stocks and bonds always, or not always, but mostly trade opposite each other. Now, when you have this big gap, all right, well, let's look at the other side of the story, right? Is what happens when interest rates are falling. It means financial conditions are tightening. There's less money in the system. All that to say is when that happens, stock prices should be headed lower. But right now, we have this big gap. Stock investors think that inflation's coming, the economy is great, they could care less how bad Europe is and what's going on in Asia. They think the U.S. is all out there by ourselves, and we are going to drive the economy going forward because it is the best time ever to invest. The bond market says you stock investors are clueless. You are running on emotion. You are just chasing something that you don't understand, and that we're going to be right. Now, the problem with this is one side's going to be right, and we know that U.S. Treasury yields peak 3 months on average before the stock market peaks. We are officially almost 8.5 months since Treasury yields peaked. The longest this has ever gone is 14 months. The shortest is the same month, 0 months. Now, the implications, as I mentioned, are big. If the stock investors up here are right, then that means what they're hoping is all these bond investors are going to sell their bonds, buy stocks, and drive the market up, maybe the S&P to 3,500, 4,000, who knows, throw some giant number out there, it's just as valid as any other. The bond market is hoping that they're right, and then all these stock investors are going to be selling and forced to buy bonds, which is going to drive interest rates to zero and make nice, big, fat, double-digit returns for bondholders. That's what everybody thinks. Again, one side can be right. Now, how do you know which side is right on this deal? Well, it's pretty simple. If interest rates are wrong, then there should be a lot of money floating around the system. There should just be oodles and oodles of money, and investors should, just things should be happening. There's not. The Federal Reserve is tightening. You would also expect to see large commercial banks lending like crazy because, look, if money's just free and cheap and easy and just all over the place, what do you want to do? As soon as it hits your hands, you want to get rid of it. Pass it to the next person, right? It's like hot potato. Hey, gone. Nope, nope, nope. So banks should be lending like crazy because they're going to make more money when interest rates are higher. But they're not. They're buying bonds like crazy. So all this to say is it looks like the stock investors are wrong. And most of the time, the bond market is right because the bond market's bigger, it's deeper, and more people invest in it than they do the stock market. So it's a much better predictor of where the economy is headed. So the end of the story is, what's coming up that could change that? Well, second quarter earnings could be a very big driver of an adjustment to either side. Now, the way we know what's going to happen with second quarter earnings is this week we saw consumer prices head down a little bit. And when we saw producer prices head up a little bit. Now, put yourself in the perspective of a business owner. You own a large business, let's say. And what does it mean when producer prices are rising? Your input costs, the things you're buying to manufacture, are rising, and your sales price is falling. That means your margin of profit is shrinking. That's what that means. Now, what do you want as a business owner? Well, you'd love if your input prices are falling and consumer prices are rising, or if consumer prices are rising twice as fast as your input costs. That would be great. But businesses don't like it when their input costs are rising and demand, which is why consumer prices are falling, is going down. That's what they don't want. So we have a little bit of a preview that is telling us, and we have a couple companies that have reported earnings that next week is when the big flurry starts, that know if the second quarter wasn't that great. And as a result, my guess is stock prices will have an adjustment when people find out, did this company that I put all my money in, did it make the earnings, or did they buy enough of their stock back to justify their earnings? And I'm going to guess we probably aren't going to see as much of that as people are hoping for. All right, so let's go take a look at the charts. And I don't have very many of these this week, but nevertheless, the M2 money supply growth rate is continuing to rise, 4.84 on an annualized basis. This thing is just hopping, but I'm going to tell you why. The 6-month rate of change is at 2.86. This is over 5%, so saying the annualized rate's going up. And the 3-month rate of change is at 5%. So if you multiply this by 4, and all that tells us is the money supply is growing. Now, why is the money supply growing? And I will admit, I was wrong. Partially, I am right. Yes, big money is moving into cash, but the real reason is the U.S. Treasury is pulling money out of the Federal Reserve banks because the government's running out of money. This happens, pretty much every year or so. The government's running short on money. There's no new budget passed, so the Federal Reserve banks are holding all this excess money that the government borrowed, and now the U.S. Treasury is saying, hey, we need that. As the Treasury pulls that money out so the government can pay its bills, right? Social Security, Medicare, military, all that other stuff. It adds to the money supply. Now, as soon as a budget is passed and the U.S. Treasury can go out and start buying or issuing more debt, and they will, guess what's going to happen to the money supply? It's going to go rocket right back down, and then once again tighten financial conditions. So that's the story on that. Commercial industrial lending did contract 3 weeks ago on a quarterly basis. It did get there. It has nudged up a little bit, but this is headed lower because the 3-month rate of change right now is sitting at a 4% on an annualized basis. It hit negative and then it bounced up slightly, but this is still very, very weak. Consumers, I mean, again, you look at our stock investors, right? Well, this doesn't tell you they're right. This, when commercial industrial lending is growing, not decelerating, that's what you want to see. And you certainly don't want to see consumers in their credit cards charging less, and less. And that's what we're seeing. The growth rate on credit cards is falling, so consumers are charging less. And the Federal Reserve balance sheet did increase by $2 billion for the week, but I didn't bother printing the chart because it would only just show a slight increase. But this soon will be coming to an end at the end of September, barring any changes from the Fed sooner. Bank deposit growth is up to 2.92%. Also, this is not a sign stock bulls want to see, because this is implying that consumers are doing what? Saving money. So David Rosenberg, the chief economist, I'm not sure what his official title said, Gluskin Chef, posted this on Twitter. Probability of U.S. recession 12 months ahead as predicted by this is the New York Fed model. This is not his model. This is published by the New York Fed. And so he says, for those who, quote, can't see the recession, quote, It's illustrated for you in this chart. The New York Fed model now pegs recession risk at 32.9%. You go, well, that's not that big of a deal. That's at its 12-year high. History shows, and he drew a line here, there's no turning back at this level. Once we reach this level, it can go higher, but we are going to have a recession, no questions asked. Now, I thought this chart was interesting too, and I didn't even know the Federal Reserve System actually kept track of this data, but they do. And there's all this talk about getting people in the market to buy stocks to create what's called a blow-off top, where stocks just surge straight up. But when you look at this, you're going to realize there's nobody left to buy stocks. So, share of corporate equities and mutual fund shares held by the top 1% of wealthy Americans or people. I guess they actually don't even stipulate who. Top 1%. Almost 51% of all stocks are owned by the very richest people in the world. Wow. Looking at the top 10%, so if you now add some more, they own 86.8% of the market. And the top 50% wealthiest Americans, obviously that's going to include many of the people on here because you actually have money, or maybe people in the world. So if you have virtually any money in the market, you're practically in this range. Already own 99.2% of the market, leaving the bottom 50%. The bottom 50% own 0.8% of all stocks. And guess what? Those 99.2% want that 0.8% to come in and buy stocks so the stock market will do this so they can sell. Yeah, good luck with that. If you think that's going to happen, probably no chance at all. Those people don't have any money. That's why they're in the bottom 50%. I'm not being insulting, just being as a matter of fact. That's why they're not buying stocks. So we look at the NASDAQ McClellan Summation Index. Stocks are at all-time highs, and this is nowhere near its previous high. Still saying there's something wrong, but the markets keep grinding higher. Looking at the climate conditions coming up, we do see a lot of heat coming, above average heat coming to the Midwest. And in the next week, drier conditions, which I'm sure farmers will appreciate, even though they are still in flood conditions. They still have standing water all over the place. And then more dry conditions coming, below average rainfall. But in the meantime, 8 states are going to get hit by this tropical depression. I believe it's Barry. I don't know if it's officially a hurricane or not, but it's going to come up in here through Louisiana. The Mississippi is already at very, very high levels, threatening to bust the levees. But here's the big issue. All the water east of the Rockies, west of the Appalachians, all flows down here into the Gulf of Mexico. And I don't know what the official term for this is, but it does. And one thing that's important to understand is when you have all this flooding from here, all of this water comes down to the Gulf of Mexico. But what it brings with it is all these chemicals, oil, think about all the roads that are covered in oil and stuff. That gets picked up by the water. You have chemicals from cars and machinery and factories, everything that's been flooded, waste from human waste and animal waste and carcasses from animal, all kinds of junk gets drugged down here, down the Mississippi into the Gulf of Mexico. Now what's going to happen this weekend is the storm is going to pick up a lot of that stuff and drop it all across 8 states. So a bunch of contaminants and stuff that we don't really want that should be properly recycled that got pulled down by the floods are going to get dumped over a bunch of farmland. Not good. And as a result, we saw a little bit of a rally in ag commodities today. Now, looking at the large commercial banks, we see they bought $14 billion in U.S. Treasury securities last week, $3 billion in mortgage-backed securities. So we're at $17 billion. And then they bought $11 billion of non-mortgage-backed securities for a total of $27 billion worth of bonds. Whose side do you want to be on? The banks, smart money, or everyone else chasing the stock market? To put that in perspective, I went back and looked at a year ago. The banks have bought over $500 million worth of bonds. And while you cannot say this is exactly the case, you could say they have bought enough debt that is half of our government deficit last year. Pretty impressive. They bought, and now they didn't buy all $500 billion in U.S. Treasury bonds, but they bought a lot of them. I mean, like $400 billion worth. That's that's pretty impressive. All right, so let's take a look at, let's go look at some charts. We'll spend probably the rest of our time here because I don't have any other charts to show you. So let me clear some of this stuff out of the way and see if we can make sense of this. So we've got the S&P 500, NASDAQ 100, Dow Jones Industrial Average, all driving new highs going into earnings season, which I'm going to be fairly impressed if they can actually substantiate this. I don't think they're going to. Oh, I kind of realized I had this sitting here. The gold playbook. I know, the awesome one-sheet playbook. So what did we learn this week? Well, we learned that interest rates were flattish and consumer prices went down. So the general trend here is interest rates are down, consumer prices are down. And what does that tell you? Gold playbook says, oh, it's over here. No, don't buy. It says it's the wrong move. We'll get to that. All right, so back to the charts. I do think that's kind of cool. Anyways, the small caps are telling us that the large companies are headed the wrong direction because small companies drive the economy, not large companies. Even though large companies are dominating the market due to the market cap weighting of the S&P 500 and the NASDAQ, which is giving the Dow the benefit of the Dow. And what that means is when you buy the S&P 500, more of your money goes into the largest companies than it does the smallest ones. So as more money flows into the market, it drives the stock price up of those higher companies, which are in turn becoming the entire market in a sense. So when you see small caps going down against large caps, and we'll go ahead and overlay the S&P 500, you can see that there's a gap. And these gaps, you can see here, if you go back to 2014, you can see large indices, large S&P 500, I'm sorry, in purple, there was a gap, it came down, brought small caps with it. But you can see large caps either bring them up or they bring them down. In this case, small caps made a high, a lower high, and another lower high. You can see the moving averages are all pointed down for the most part, except the 100-day. That tells you what direction that large caps should be heading. Small caps are giving a big indication here. Let's take a look at volatility, which is continue to get hammered. It'll be very interesting today when all these people that have been shorting volatility for the last decade have to become buyers of it, because we will see a market crash like you've never seen in your life. Looking at 5-year Treasury yields, we can see they're getting consolidated here. They finally, it looked like they were going to break lower. They finally, on the news of the consumer price index, I don't see how that's a big deal. Or more of it on the Fed looking like their ease still not enough to drive yields higher. It got pushed up a little bit. The 50-day moving average in green is headed lower. At some point, these two will touch again. And remember, when you have a cross of the 50-day and several confirmations along the way, it means that that trend is going to continue or has a high probability of continuing. So what this tells us is yields are still in a bear market until otherwise spoken. Now, this was a huge point for the Treasury bears, because they're bearish Treasury bonds, bullish on yields, to defend, because once you get under here, you're going all the way down. 5-year Treasuries are just going to start to collapse. There's not a lot left holding them. 10-year Treasuries, they got nudged up too after almost getting back to their pre-election lows, almost got there, and they're going to have a meetup with their 50-day moving average pretty soon. And then we saw an overnight trading. Those who've been 30-year yields tagged the 50-day perfectly and were rejected right back under their resistance levels, again suggesting that yields are headed lower here. And if we zoom out, you can see, they crossed their 50-day and they came back over it, tagged the 200-day, but are now following their moving average down. Again, this is also bearish for yields, suggesting that yields are headed back likely to their all-time low and probably lower. Let's take a look at the energy sector. We haven't looked specifically at this in a while. This is a broad energy sector, symbol XLE. And previously we noticed this trend here, and it brought prices down. Investors jumped back in, hit the 200-day moving average, and fell. So it peaked, made a lower high, and now it's in the process of making another lower high. And when you see lower high after lower high, it's bearish, meaning that the most likely direction for the energy stocks is lower, not higher. Let's take a look at banks. Where's banks? XLF. So banks are trying to get up here and drive stock prices higher. Treasury yields higher, because you can kind of, let's do it this way here. Let's go back to 10-year Treasury yields. Let's overlay the S&P 500 real quick, because we didn't do that before. And you can see when we look at a 2-year scale, they're pretty well entrenched, and there's this just monster gap here. And either stock prices go down, Treasury yields go up, which would imply the Treasury yields should be well over their peak, not likely, or stock prices should be well back to their December lows and even lower, more likely. Let's take a look now. Let's see if we can edit this real easily. Normally doesn't work. Yep, didn't think so. Yep, let's remove that. Let's add on banking stocks. We'll use the regional banks instead of the large ones. And you can see that Treasury yields and bank stocks tend to fall. So bank stocks are headed higher. At least they're trying to head higher. I mean, they're making a series of lower highs. At least looks like a potential topping pattern here. And either yields need to go up or bank stocks need to go down. Obviously, lower yields mean tighter financial conditions. Banks make less money. From a volume perspective, the S&P 500, the largest ETFs, trading at very low volumes despite making new highs. We'll kind of see how that plays out as next week kicks in. Let's continue on looking at bonds. We saw the 7 to 10 year Treasury bond ETF, which we've now exited this position to take a position in the longer term bonds. It came back here. This is a nice area of support. Why? Because there's support here, support here, support here. These former areas of resistance are acting as support. The 50-day moving average will be moving up, probably touch this, I would guess, by the end of next week. This is still bullish until otherwise spoken, and a move back up here gives Treasury bonds a breakout of their all-time highs. Now we shifted over to the long bond, because if interest rates, 10-year Treasuries go to zero, which they will during the next recession, that means 30-year Treasury bonds, which this is a proxy of, will probably get down to 0.5% or so. That's a double-digit 30% return from this. Here we see it tagged. Its 50-day moving average is sitting right at this level of support. I could actually move this dashed line down a little bit, maybe be proper. But what did we see today? We saw a reversal of that trend, and it came right back over that resistance level and closed over. That's exactly what you want to see. And see how it got over resistance, and it confirmed it, and boom. So it's telling us that all these short sellers are not playing with a strong hand right now. They just try to take advantage of this. But again, the banks bought $25 billion worth of bonds last week. The banks are on the side of bondholders. All right, let's take a look at gold. Gold is continually trying to break out of this level, and everyone's very excited about the potential of this. And I am long-term excited about it, but not short-term excited about it. And let's take a look at why. Let's see, oh, you know what? I want to look at it on the mining stocks. So you see it's bulled up over here, a failure here. I mean, it still has not reconfirmed its moving averages. Every time it crosses over them, it comes back through. It has not really provided us a nice confirmation of what we want. What we want to see is like we had here with Treasury bonds, right? Cross the 50-day. Yeah, okay, it bounced through it, but it confirmed a longer-term moving average. Reconfirmed the 50-day, confirmed the 50-day, confirmed the 50. That's the pattern you want to buy. You don't want to buy this where it's chopping through it, because chopping through often means it goes down. Often, not every time, but often what that looks like. So when we comes to gold, that's what we want to see too. Now let's look at the junior miners. This is our most likely destination, just due to the trading volume and the upside potential. But look what happens when this clusters. I was just looking at this earlier. See when it clustered here? Now look, let's see the last time it clustered, it went down. And you see it clustered here, went down. Clustered here, went down. Now this cluster was kind of angled upward, but notice this is just kind of clustering kind of like this. It's just oscillating up and down. Again, supports the view that this ought to pull back. And if gold miners are indeed following U.S. Treasury bond prices, this move down here should also correlate to a move down here. Now, it may just come in here and hold this moving average. That would be fantastic. It may go a little bit lower or all the way down here, follow the Wyckoff chart pattern, which would signal a monster buy. But somewhere in here seems more likely where this is headed. What do we got next? Let's take a look at the dollar. And that wasn't the dollar. That was crude oil. But we can look at crude oil. See, here's the high, lower high, lower high, lower high, bearish. Oh, you know what I wanted to look at? Oil and gas producers. Now, I know there's a lot of people that watch this that are either in the industry or retired from the industry. And again, do not take this in the wrong way, but I'm going to show you something that you don't. Some of you want to see it because you want to buy these stocks when they're cheap because you know the upside potential. The rest of you that own them, you don't want to see this. So this is a clear topping pattern. How do we know? Because it went from here, made a high, tried to make a higher high. It didn't. It pretty much failed at the same price level. And now we see a lower high, downward facing moving averages. This is bearish, headed back to its December lows. This is the XOP. This is oil and gas producers. This is going to be a lot of your smaller companies. You're not going to see as many of your larger companies in here. You see some, but a lot of small oil and gas producing companies. Now, from a technical perspective, you could draw a line here like I did. We'll say it's around $22 a share. And then you go look at where it peaked, somewhere around $44 a share, and you take the difference, which is 44 minus 22 is 22. You subtract 22 from the low, and it tells you where this should head. And you say, wait a minute, that implies this is headed to zero. Correct. And that's the part that you didn't want to hear. And this is not unrealistic. If you look at the break-even price of oil, for a lot of these small producers, it's in the $50-some per barrel. If you look at the amount of debt these companies are holding, it's astronomical. I mean, they're just holding incredible amounts of debt. So if oil prices go down, which they do during monetary decelerations to begin with, and during recessions, and during a period where there's tariffs, oil and gas producers are going to go down. And what this chart is telling us, it's going to be a monster amount of bankruptcies. Now, the good news is because this is an exchange-traded fund, it doesn't really go to zero. What it means, though, is when it does get down that low, you have the buying opportunity of your life. And people want to buy stocks when they're high. I'd like to buy this when it's sitting at, say, $1 or $2 a share, because I know I could probably own it for another 10 years and make a fortune doing it. All right, on to the dollar. Dollar should have one final upthrust. It's struggling right in here, but it's done that before. Until it turns and rolls over, it means we should assume the dollar is going to go higher. We have to assume gold's going lower. From an inflation standpoint, we can look at lumber or wood, W-O-D, and what does it tell us? It found support here, tried to break out, made a topping pattern, came crashing down, bounced off of support, made a lower high, and is now back under its 50-day moving average, headed lower. So again, everyone that's telling you that stock prices are headed higher and bond yields are headed higher are wrong, because lumber is telling you there's no demand. So how do you get higher stock prices and higher inflation when demand doesn't exist? You don't. All right. 2 minutes left. We'll wrap this up. Let's look at ag commodities. Here's a sleeper story that no one's paying attention to. Here you have a cross of this. This is resistance. So you have a left shoulder ahead, a long forming right shoulder, and here we're sitting right at the neckline and just closed over it today, right over its 200-day moving average, this tan line. And if you measure from here to here, and that tells us this thing is headed somewhere right up into here. So let's just say it's going to head up to this level, this purple line here, which is resistance. Let's say it just crosses over and holds resistance. Talking about a 5% price move from here. And then at that point, you're also got all these people that are short in here that are going to start taking on long positions. You'll have momentum starting to turn. Computer algorithms will start to adjust. And there's a catalyst for this to go higher. The risk for the economy is when food prices go up, and they should during solar minimums, it's normal, and you're in a tight financial conditions, you've got a big problem because people got to eat. And that always drives economies into recession. All right, so with a few seconds left on the clock, we've got the Fed, who is desperate to lower interest rates. Why? Well, simple. The Asian economy is tumbling. European economies headed toward recession. The Fed wants to cut because what will happen is all the other central banks will follow whatever the Fed does. The problem is the data on the producer price index suggests that, and even the consumer price index suggests that the Fed is actually just where it needs to be. And it's going to be real difficult because they're desperate to cut. They really want to, even with stock markets at highs, even with all this going on, they want to cut because they know financial conditions are tightening. So if they're data dependent, we'll find out, they really don't have a whole lot of latitude. Maybe a 0.25%, but they're going to come up with all kinds of reasons why they're going to do it because the data doesn't suggest it. And that's coming at the end of the month. So we'll see. But with Monday, we have earnings kicking off and maybe the fireworks will begin. And if not, I'll tell you in a couple weeks why October seems to be when markets tend to crash. I'm Steve Van Metre. Have a great weekend.